Ladies and gentlemen, system failure. Over the last 24 hours, more than $10 trillion basically vanished from global markets. 10 trillion. To put that in perspective, that's almost half of China's entire economy erased in a single day. That's more than the GDP of Japan. That's more than the combined market cap of Apple, Microsoft, and Google. Gone in 24 hours. And if you went 24 hours without watching the charts, without checking your phone, without opening your brokerage app, when you came back, you probably felt a punch in the gut. Silver went from $121 down into the $98 area. Gold dropped from $5,600 to around $5,030. That's a $23 drop in silver. That's a $570 drop in gold. In percentage terms, silver dropped 19%. Gold dropped 10%. In a single day. And I know exactly what went through your head. What happened? Is this over? Should I sell right now? If that crossed your mind, breathe. You're not alone. Right now, somewhere in the world, someone is staring at their screen watching their portfolio bleed. Liquidations triggering more liquidations. Stop losses getting swept. Leverage positions getting annihilated. Margin calls forcing people to sell at the worst possible time. And the mainstream financial media will tell you the same old story. Normal volatility, technical move, profit taking after a strong rally, nothing unusual. We both know that's not true. What happened wasn't random, it wasn't an accident. And if you don't understand why this crash happened, the next one will hit you even harder. I've seen this movie before, recently. And here's what almost nobody is connecting. I've seen this exact pattern before. Not years ago, not in some other cycle, weeks ago. Late December 2025, the last 2 days of the year, same panic, same liquidations, same it's over sentiment. People posting on social media that the rally was done, that it was time to sell, that precious metals had peaked. And you know what happened right after? January 2026 exploded. Gold up 30% in 1 month. Silver up 65% in 1 month. The biggest monthly rally in decades. So the real question isn't, is it over? The real question is this the end or the beginning of something much bigger? By the end of this video, you're going to understand what actually caused this crash, the invisible force that moves gold and silver that most people ignore, the historical pattern that often shows up right before major upside legs, and most importantly, I'm going to explain what I think happens next and why this might be an opportunity, not a disaster. Ken AG here. If you're new to the channel, welcome. And a quick note, when I checked the channel analytics, I saw that about 83% of viewers aren't subscribed. If this content helps you think more clearly, subscribe. It keeps this channel alive and independent. Quick disclaimer, you already know it. Educational, informational, not a recommendation. Do your own research. Now let's get to what matters. What actually happened in the last 24 hours? Today is Friday, January 30th, 2026. Around 10:30 a.m., Eastern Time, gold was at $5,600 per ounce. Silver was at $121 per ounce. Less than an hour later, gold was below $5,100. Silver was near $108. And after that, it kept sliding. By the afternoon, silver had touched $98. Gold had briefly dipped below $50,000. That's $500 wiped off gold and $23 wiped off silver in 60 minutes. If you had $100,000 in silver at the top, you now have $81,000. $19,000 vanished in the time it takes to watch an NFL game. And if you were leveraged, if you were trading on margin, if you were holding futures contracts or short-dated options, this wasn't volatility. This was execution. This was your position getting closed out, whether you liked it or not. Liquidations aren't opinions. When price drops fast, leveraged traders get margin calls. They have to sell. It's not optional. The broker doesn't ask if you want to. The system automatically liquidates your position to protect itself. That selling pushes price lower. That triggers more margin calls on other traders. And that's how the cascade starts. It's an automatic chain reaction. No emotion, no mercy. And the people who bought the top, thinking it's going higher, became exit liquidity. Hard to hear, but it's true. Let me explain the mechanics more carefully, because understanding this is critical. When you trade on margin, you're borrowing money from your broker to increase your position size. If you have $10,000 and you use 5-to-1 leverage, you can control a $50,000 position. That amplifies your gains. If silver goes up 10%, you don't make $1,000 on your $10,000. You make $5,000 because you control $50,000 worth. But it also amplifies your losses. If silver drops 10%, you lose $5,000. But here's the deadly part. You don't get to decide when to take that loss. The broker does, because they're the ones lending you the money. They're taking risk on your position. So they set maintenance margin requirements. You need to maintain a certain percentage of equity in your account relative to your position size. If price drops enough that your equity falls below that threshold, you get a margin call. And if you can't deposit more money immediately, they liquidate. They sell your position at market, regardless of where price is. Now imagine thousands of traders all leverage the same direction, all long silver around 120. When price starts dropping, when it hits 115, then 110, margin calls start hitting. Forced selling begins. That selling pushes price to 105. More margin calls, more forced selling. Price drops to 100. Even more margin calls. It becomes a death spiral. And the price they're getting liquidated at keeps getting worse because their selling is pushing the market lower. That's why leveraged markets are so dangerous during volatility. The forced flows overwhelm natural buying. Even if fundamental buyers would happily buy at 100, even if that's a great price, they can't absorb the wave of forced selling fast enough. So price overshoots to the downside. It goes lower than fundamentals justify. But it does it because the mechanics demand it. The system is flushing out leverage. And once that flush is complete, once the leveraged positions are cleared, price can stabilize and recover. This wasn't an accident. Crashes like this don't come out of nowhere. Somebody saw it coming. Institutions saw it. Funds saw it. People with access to order flow data you'll never see, with algorithms tracking positioning, with inside information about regulatory changes or policy shifts. They were already positioned. They sell first, they buy later. That's how it's always been. The question is, do you want to keep playing without understanding the board? The real culprit, the dollar. Gold and silver didn't fall because they're weak. They didn't fall because the fundamentals changed. They didn't fall because demand disappeared or supply suddenly flooded the market. They fell because of one thing, DXY, the US dollar index. And here's what completely changes your market read. Gold and silver move inversely to the dollar. Not sometimes, not occasionally. Dollar up, metals down, metals up. It's a seesaw. And today the dollar side shot straight up. The DXY, which measures the dollar against a basket of major currencies, spiked from around 107 to nearly 109 in hours. That's a massive move for a currency index. A 2% move in DXY doesn't sound like much, but when you're talking about the world's reserve currency, when trillions of dollars of assets are priced relative to it, a 2% move creates chaos. Why did the dollar rise? Three forces. First, hawkish Federal Reserve. The Fed is maintaining a tight monetary policy, higher rates for longer. No pivot in sight. When the Fed keeps rates elevated, when Treasury yields stay high, the dollar becomes more attractive. Global capital runs into dollar-denominated assets. Foreign investors buy treasuries. They need dollars to do that. That buying pressure pushes DXY higher. When that happens, metals get hit. Simple, mechanical. Think about it from a foreign investor's perspective. If you're holding euros or yen or yuan and U.S. Treasury bonds are yielding 4.5% while your local bonds are yielding 2%, where do you put your money? You convert to dollars. You buy treasuries. That creates demand for dollars. And when dollar demand spikes, everything priced in dollars that investors hold as alternatives gets sold. Gold, silver, commodities, because you need to raise dollars to buy those bonds. Second, China slowing. This is especially bad for silver. More than half of silver demand is industrial, solar panels, electronics, electric vehicles, semiconductors, data centers. And where does a huge chunk of that manufacturing happen? China. When Chinese economic data weakens, when PMI numbers come in soft, when property markets show stress, the market extrapolates. It assumes industrial demand for silver will decline. That assumption, whether accurate or not, creates selling pressure. And here's why this matters more for silver than gold. Gold is primarily monetary. About 60% of gold demand is jewelry and investment. It's not dependent on industrial production. But silver is different. 50% industrial, 50% monetary and investment. So when industrial demand fears hit, silver gets sold harder than gold. That's why in this crash, silver dropped 19% while gold dropped 10%. The industrial component makes silver more volatile to growth scares. And here's why this matters more for silver than... Third, U.S. government shutdown fear. Political uncertainty equals risk reduction. We had headlines about budget disputes, about potential government shutdowns, about political gridlock. And after a brutal rally, after gold was up 30% and silver was up 65% in just 1 month, a lot of people were sitting on massive gains. They were looking for any excuse to take profits. The political uncertainty gave them that excuse. It triggered profit-taking. And in a leveraged market, profit-taking becomes forced selling, which becomes a crash. But here's what you need to understand. The profit-taking wasn't irrational. When you're up 65% in a month, when your position has gone from, say, 100,000 to 165,000, you're naturally thinking about locking in gains. You're thinking, what if it reverses? What if I give it all back? So you start scaling out. You start selling portions. And if everyone who's up big starts doing that at the same time, the selling overwhelms buying and price drops fast. Why this doesn't mean it's over. Now listen closely. What changed today? Sentiment, fear, positioning, leverage. What didn't change? Silver's structural deficit, 5 consecutive years of supply deficits. That didn't change. Record central bank gold buying. Central banks bought over 1,000 tons of gold last year. That didn't change. Global de-dollarization. Countries building alternatives to dollar payment systems. That didn't change. Mine depletion. Ore grades declining. Extraction costs rising. That didn't change. The long-term thesis. Industrial demand accelerating. Inventories draining. None of that changed. Weak hands panicked. Strong hands accumulated. It's always like this. The people who understand fundamentals, who have conviction based on supply and demand analysis, they don't panic on a 20% drop. They accumulate. They see it as an opportunity to add to positions at better prices. The people who are trading on emotion, on momentum, on FOMO, they panic. They sell at the bottom. They transfer wealth to the prepared. December already showed this pattern. Late December 2025, we had a violent drop. Total fear on social media. People saying the rally was over. Silver dropped from around 95 to 78. Gold dropped from 4,200 to 3,850. It looked terrible. The sentiment was apocalyptic. And then January happened. Historic explosion. Silver from 78 to 121. Gold from 3,850 to 5,600. If you sold in December panic, you missed the biggest monthly move in decades. Now we've got the same setup. Violent drop, total fear, month-end positioning, which always creates volatility as funds rebalance. And February is coming. Does the pattern repeat? I don't know. Nobody knows. But the setup rhymes. Let me explain why month-end matters, because this is important. Institutional investors, pension funds, mutual funds, they rebalance at month-end. If gold went up 30% in January, it's now overweight in their portfolio. They have to sell some to rebalance back to target weights. That selling pressure happens at month-end. It's mechanical. It's not about fundamentals. It's about portfolio management rules. And when every major fund is doing it simultaneously, you get concentrated selling that pushes prices down hard. But here's the thing, after month end, that selling pressure disappears, the rebalancing is done. And if the underlying bid is still there, if physical demand is still strong, if the fundamental drivers haven't changed, price recovers. We saw this in December. We might be seeing it now. The 3 scenarios, let me walk through how I'm thinking about what happens next. Scenario 1, bull continuation. Probability I'd assign 60%. The correction clears excess leverage, resets sentiment, and sets up the next leg higher. Silver breaks above 150. Gold breaks above 6,000. This happens if the dollar tops out here, if the Fed signals any dovishness, if Chinese stimulus gets announced, if physical demand stays strong. The fundamentals support this scenario. In this scenario, what you'd see over the next few weeks is stabilization first. Price chops around between 100 and 110 for silver, 50 to 5,300 for gold. The forced selling stops. The margin call's clear, and then, quietly, accumulation begins. Not with big green candles. With slow, steady buying. The dips get bought. Support holds. And eventually, price starts grinding higher. First back to 110, then 115, then 120. And once it reclaims the old highs, once it proves the correction was just a correction, momentum returns. New buyers enter. FOMO kicks back in. And the next leg takes silver to 150 plus. Scenario 2. More pain. Probability 30%. The dollar keeps rising on safe haven flows. Risk assets keep selling. Silver tests 90. Gold tests 4,800. This happens if we get a broader market crash, if there's a genuine financial crisis, if risk-off intensifies. But even in this scenario, it's temporary. Because if you get a crisis, if you get systemic stress, that eventually drives people into gold and silver as safety assets. So it's a short-term drop followed by a massive rally. In this scenario, the next few weeks are brutal. Equity markets crash. The S&P drops from 7,000 to 6,000 or lower. Credit spreads blow out. Volatility spikes. And in that environment, everything gets sold. Even gold and silver, even though they're supposed to be safe havens, get sold initially because people need to raise cash for margin calls and other positions. But that selling creates the setup for the biggest rally. Because once the liquidation is done, once the forced sellers are out, the fundamental buyers step in aggressively. Central banks, sovereign wealth funds, people fleeing financial assets for physical safety. And that wave of buying drives metals to new highs, far above where they were before the correction. Scenario 3, choppy sideways grind, probability 10%. The market exhausts retail, chops around in a range for weeks, frustrates everyone. The big move comes later when nobody expects it. This is the most frustrating outcome, but historically, it happens. Markets love to torture the maximum number of participants. If we get stuck in a range between 90 and 110 for weeks, people give up, they exit positions, and then the breakout happens. In this scenario, you see silver ping pong. One day it's at 105, next day it's at 98. Day after that it's back to 103. No trend, no direction, just noise. Traders get chopped up. Every time they buy thinking it's bottomed, it drops more. Every time they sell thinking it's going lower, it bounces. This range trading destroys confidence. People give up. They move on to other things. And that's exactly when the breakout happens, when positioning is neutral, when nobody's paying attention, when the people who would sell a rally have already sold. That's when it gaps up and runs. On the record view. Meanwhile, in the real world, Shanghai silver is still trading around $122. That's roughly $24 per ounce above Western paper prices. In India, it's around $128, a $30 premium. If silver were abundant, if supply was easy to source, that spread would close instantly. Arbitrage would crush it. The fact that it persists, that it's been there for weeks, tells you something. The West trades contracts, the East takes delivery. Paper can be forced to sell in a liquidation cascade. Physical can't be forced. It just sits there. And when paper price drops but physical premiums stay elevated, it tells you the real price, the clearing price for actual metal, hasn't changed. Only the paper quote changed. That's why I believe the pressure continues into February. Not in a straight line, not without volatility, but the structural drivers are intact. The deficit is real, the demand is real, the supply constraints are real, and the repricing from paper to physical is happening whether Western markets acknowledge it or not. What to do now without hysteria? If you hold physical metal, do nothing. Physical isn't a trade, it's insurance, it's wealth preservation. A 20% drop in paper price doesn't change the fact that you have ounces. If you bought physical at $20 years ago, you're still massively ahead even after this drop. If you bought at 100, you're roughly flat. But the reason you bought, presumably, was long-term thesis, not to flip for a quick profit. So don't let paper volatility shake you out of a physical position that serves a strategic purpose. If you're leveraged, this was your warning. Reduce it or get out. Leverage amplifies gains on the way up, but it forces liquidation on the way down. And liquidations happen at the worst prices. If you want to participate in precious metals, if you believe in the thesis, do it with capital you can afford to hold through volatility. Don't use margin. Don't use options unless you really understand what you're doing. Because moves like we just saw will wipe out leveraged positions even if the long-term direction is correct. If you're sitting in cash, moments like this aren't common. Fear creates opportunity. But don't rush. Buy in steps. Scale in over days or weeks. Don't try to catch the exact bottom. Nobody does that consistently. But if you believe in the thesis, if you understand the fundamentals, a 20% drop creates a better entry point than existed yesterday. Just be patient. Let the dust settle. Let the volatility subside. Then add exposure gradually. And here's a critical point about emotional discipline. The worst trades happen when you let fear or greed override analysis. Fear makes you sell at bottoms. Greed makes you buy at tops. The way to avoid that is to have a plan before the volatility hits. If you bought silver with a long-term thesis with an understanding of supply deficits and industrial demand, then a 20% drop shouldn't change that thesis unless the fundamentals changed. Did the deficit disappear? No. Did industrial demand collapse? No. Did inventories suddenly refill? No. Then why sell? The final line you need to remember. As Warren Buffett would say, markets exist to transfer wealth from the impatient to the patient, from the emotional to the prepared. Today, trillions changed hands. The question isn't what happened. The question is, which side of that transfer are you on? Were you the one panic selling at 98? Or were you the one calmly analyzing the situation and recognizing that nothing fundamental changed? Were you trading on emotion or on analysis? Let me give you a historical example to drive this home. In March 2020, when COVID panic hit, gold dropped from $1,700 to $1,480 in 2 weeks. Silver dropped from $18 to $12. People panicked. They sold everything. They raised cash. They thought the world was ending. But by August, gold was at $2,100. Silver was at $30. If you sold in March panic, you missed a 70+% move in silver in 5 months. The people who understood that the fundamental drivers, loose monetary policy, fiscal stimulus, supply disruptions, were actually bullish for metals, they bought the panic, and they made fortunes. This feels similar. Violent drop, extreme fear, everyone questioning if the rally is over, but the fundamental drivers are still intact, maybe stronger than before. So, this might be March 2020 all over again, a gift for those who can control their emotions and think clearly. What I'm watching now, I'm watching the dollar. If DXY tops out here around 109, if it starts rolling over, that's the signal that the pressure on metals is easing. I'm watching Chinese economic data. If we get stimulus announcements, if PMI numbers stabilize, that supports industrial silver demand. I'm watching physical premiums. If Shanghai stays at 122 and India stays at 128, while paper is at 98, that divergence will eventually force paper higher. You can't maintain that kind of spread indefinitely. I'm watching COMEX inventory data. If registered stocks keep draining, if we see large delivery requests in the next contract month, that confirms physical tightness. And I'm watching sentiment. When fear is extreme, when capitulation is obvious, that's usually the best time to add exposure. Not at the top when everyone's euphoric, at the bottom when everyone's terrified. One more thing about this crash that I think is important. It reveals who was trading on leverage versus who was holding physical. If you held physical coins or bars, your net worth dropped on paper, but you still have the same number of ounces. Nothing forced you to sell. You can wait. You can ride it out. But if you were long silver futures on margin, you got liquidated. You no longer have a position. The crash took you out of the game. That's the difference between owning an asset and trading a derivative. The asset doesn't get taken from you. The derivative does. And that's why I keep emphasizing physical over paper for long-term holders. Paper has its place for traders, for people who understand leverage and can manage risk actively. But for preservation, for long-term thesis, physical removes counterparty risk and forced liquidation risk. You hold the metal. Nobody can take it from you because price dropped. Final thought. In every major bull market in history, there have been violent corrections that felt like the end. In the gold bull market of the 70s, there were 5 corrections of 25 to 47%. Every single one felt like the bull was dead. Every single one was bought by smart money and led to new highs. In the 2000s, gold bull, same thing. Multiple 20 to 30% corrections. Each one looked like the top. Each one was a buying opportunity in retrospect. We might be living through one of those moments right now, or maybe this is different. Maybe the fundamentals have changed and I'm wrong. But based on what I see, based on the data I'm tracking, based on the fact that physical markets haven't followed paper markets down, I think this is a shakeout, not a structural break. If this video helped you stay calm, if it gave you perspective, hit like and subscribe. Share it with someone who's panicking right now who needs to hear this analysis. Watch my other videos to understand the fundamentals deeper. And don't spiral. Stay calm, stay prepared. Remember, the market doesn't care about your fear, it rewards understanding. I also recorded a video titled, "Should I Sell My Silver Now?" My honest answer, explaining my full value thesis. It's worth watching if you're questioning your positions. Thanks for the trust. Tell me what you think about what just happened in the comments. I read them all. See you in the next video.